audible?
Yes, sir. Good evening.
Ah, shall we start, Harsh?
Yes, sir. I think we can start.
Yeah. Yeah. Yes, yesterday we discussed this financial liabilities. Now today we'll be focusing initially how we need to recognize the financial liability in the books of accounts, and subsequently how we need to recognize the financial liability. And yeah, so initially when we are dealing with the financial liabilities, you remember initially financial liability should be recognized at its fair value. So this is very, very important. Initially, if you are recognizing the financial liability for the first time in the books of accounts, it should be recognized at its fair value. Now, if the financial liability will be held at fair value through profit or loss account, transaction cost should be now in a simple way. How we can understand is, if we are dealing with the trading company means the company which generally trade these shares. So the companies which are in the business of speculation or the companies which are in the business of investment. In that case, if we are uh, recognizing the financial liability at fair value, then the transaction cost should be shown in the statement of profit or loss account. Means the company which are in the trading business, for those companies, if the financial liabilities are recognized at a fair value, then the transaction costs, so the cost which generally they incurred on these financial liabilities, should be shown as an expense in the statement of profit or loss account, because this is very important statement you need to remember. For a trading companies, if the financial liability recognized at fair value, the transaction cost should be shown as an expense in the statement of profit or loss account. If the financial liability will not be held at fair value through profit or loss account, transaction cost should be deducted from its carrying amount. For a non-trading companies, the transaction cost should be deducted from its carrying amount. But for a trading companies, the transaction cost should be shown as an expense in the statement of profit or loss account. So this is a major difference you need to know. Once again, I repeat, when we are initially recognizing the financial liability, first we need to see whether it is a trading company or a non-trading company. Now here trading company means the company which generally deals with investments and speculations. So for those companies, the transaction cost should be shown as an expense in the profit or loss account. For a non-trading company, the transaction cost should be deducted from its carrying amount, and the net carrying amount should be shown in the financial statements. Now, for the subsequent treatment, so when we are subsequently recognizing the financial liabilities, so they can be measured. For a subsequent treatment, we can measure this. One second. Yeah. So we can measure the financial liability for a subsequent period either by amortized cost method or fair value through profit or loss account. So for a subsequent treatment, we can either go with the amortization cost or amortized cost method or fair value through profit or loss account. In these two, anyone can apply. Now, first we actually try to understand what do you mean by this amortized cost method. So according to this method, interest income is calculated using the effective date, and this is charged to profit or loss account and increases the carrying amount of the financial liability. Cash payments reduce the liability carrying amount. Now we try to understand this particular statement with an example. According to amortized cost method, interest income is calculated using the effective rate. Interest income is calculated using the effective rate. This is charged to profit or loss and increases the carrying amount of the financial liability. So cash payment reduces the liability carrying amount. Suppose let us assume that Z company issued 1,000 debentures thousand debentures at the rate of 100 each at a coupon rate of 8% per annum. Effective rate of interest is, let us assume that 7%. Yes. Now here Z company issued 1,000 debentures at the rate of 100 each at a coupon rate of 8% per annum for 3 years. It means after 3 years, this particular debenture amount should be repaid or it should be redeemed. And the effective rate of interest is 7%. Now, as per amortization model, we need to calculate the interest on the effective rate of interest. So here, just if you see the statement, interest income is calculated using the effective rate and this is charged to profit or loss account and increases the carrying amount. So whenever we are dealing with the financial liabilities, whenever we need to dealing with the financial liabilities, in the statement of profit or loss account, we need to calculate the interest at the rate of 7%, that is effective rate of interest, not at the rate of 8%. So when the Z company is preparing their financial statements, when they are showing the finance cost, when they are showing the finance cost in their books of accounts, finance cost should be calculated at the rate of effective rate of interest, not at the rate of coupon rate. So generally in examinations also they will be giving both coupon rate and this one. So in financial statements we need to calculate the finance cost on the basis of coupon rate, not on, sorry, on the basis of effective rate of interest, not on the basis of coupon rate. So we will use the coupon rate only for the purpose of calculating the present value of the debenture. So as per the financial instruments accounting standard, this coupon rate is only useful for calculating the present value of the debentures. Now let me explain how to calculate the present value of this particular debentures. The first step, when you are calculating the amortization, the first step is we need to calculate the present value of this particular debentures. So calculation of present value of debentures. So generally in this case, do remember the debentures will be repaid within a period of 3 years. So after 3 years, the debenture amount should be repaid. So how to calculate the present value? Just consider here year, that is, and cash outflow. Just take cash outflow. In this cash outflow, every year we are paying a coupon rate of 8%, and the total value of the debenture is 1000 into 100. So we'll be getting an amount of 1 lakh. So here value of debentures will be the total debentures we company issued is 1000, and each debenture cost is 1 lakh. Now here cash outflow. Now here cash outflow means the obligation of a company, the periodical or the annual obligation of a company towards the debt. Now here the company issued a debentures worth 1 lakh, and they agreed to pay a coupon rate of 8% per annum. So it means every year the company is liable to pay 8,000 rupees as an interest on that particular debentures. Now here, when we are calculating the present value of the debentures, we need to calculate the outflow. So how much outflow will be? The total value of the debentures is 1 lakh. On that, the company is liable to pay a coupon rate amount is 8%. It means the company will be paying 8,000 rupees every year. So second year also they will be they need to pay 8,000, and at the end of the third year they need to pay both principal plus interest. So here the principal amount will be the initial amount which they raise, that is 1 lakh, plus the interest amount, that is 8,000. So at the end of the third year they will be paying 1 lakh 8,000 rupees. So I hope this cash flow calculation is clear. Cash outflow, is this cash outflow is clear? Now we are trying to understand the amortization model in case of financial liabilities. So here again, discount factor, you will be knowing the formula for calculating the discount factor. So for discount factor we need to apply the effective rate of interest, that is 7%. So the formula will be, and we should calculate present value of cash outflow. So how will be getting the present value of cash outflow? And again we need to calculate the sum. So this is nothing but present value of debentures, or we can also write it as present value of a liability. Is this present value calculation is clear? So I hope this concept is clear. The present value of liability. Now, in the statement of profit or loss account, in the statement of profit or loss account, first we need to show amortization. So generally, how we will be calculating the amortization? The total present value, that is 1,02,624, divided by the total number of years. Here, the debt will be repaid within a period of 3 years. So 34,208, that is the total amortization value, and we should also charge the finance cost. So how to calculate the finance cost? Here we need to calculate the finance cost on this particular present value amount into the effective rate of interest, that is 7%. So this is a process of amortization for a financial liability. In statement of profit and loss account, we'll be showing like this according to this particular statement. So let me know if you have any doubts in this. So should I assume that this calculation is clear for all? Yeah. So how we need to calculate the finance cost is just take the present value of this particular debentures. So on this particular present value, we need to calculate the finance cost at the rate of effective rate of interest, that is 7%. It means 1,02,624 into the effective rate of interest, that is 7%. Then we will be getting the finance cost, that is 7,183. So this is a process according to amortization cost method. Now, if you are subsequently considering this financial liability according to fair value through profit or loss account, generally this particular fair value through profit and loss account is used for derivatives or liabilities held for trading. Now, for a non-trading company, this particular method will be used. It means if the companies are not engaged in trading, in that case, we will be using this. If the companies are engaged in what is this in the trading business, so generally subsequently we will be valuing the financial liability by using fair value through profit or loss account. So that's why here you can see, so this particular concept is applicable for the derivatives or the liabilities held for trading. Now here how we will be considering this, the financial liability is revalued to fair value at the reporting date, and whatever the gain or loss is there in the statement of profit or loss account. It means according to the fair value method, that particular financial liability, it should be revalued according to the fair value. So whatever rate which is prevailed in the market, according to that particular rate, it should be valued. And if there is any gain or loss in the process of this revaluation, that particular gain or loss will be showing in the statement of profit or loss account. But do remember, this fair value through profit or loss is applicable only for the companies which are in trading. This is applicable only for the companies which are in the business of which are in trading business. So we need to revalue the financial liability according to the market value, and whatever gain or loss which we get in the revaluation, that will be shown in the statement of profit or loss account. And a designation can be made to use the category in order to reduce an accounting mismatch. Now in this instance, the change in the fair value of the liability must split the change due to own credit risk or the remaining change is reported in the profit and loss account. Now, this is most important thing. Actually, this amendment was given in 2018. So, what it says is, for some companies, if they don't want to show it as a loss, if they want to minimize the revaluation profit or loss, in that case, what they can do, they can show that particular loss, whether the loss is occurred due to the credit risk, or if the loss is occurred due to any other reasons. Suppose if the loss is due to any other reason, generally that particular loss can be shown in the statement of profit or loss account. But if the loss is because of the credit risk, then we can show it in the OCA. Now here you might be getting a doubt. Now, can anyone say what exactly credit risk means? What do you mean by credit risk? Any idea? Just what does it mean? The credit risk means. I think you might have see, heard this particular word also, credit risk. Default in payment, risk of default, very good. Okay, very good. As exactly we can say the risk of default or default in payment also. Now here, why we are discussing about the credit risk concept is, we are recognizing the financial liability in a subsequent, so for a subsequent period, we are recognizing the financial liability on the basis of fair value. Now, fair value means it completely relates with the present market condition. Now, if the finance liability, the value of the financial liability in the market, if it is affected because of the credit risk of the company, because I think most of you might be knowing, uh, if the company is dealing with any kind of debt instruments, or if they are issuing any debentures, their debentures, they will be getting a credit rating also. So there is a credit rating agency called CRISIL, where they will be giving ratings like triple A, triple A plus, double A plus. Did anyone heard this? Anyone knows this? Yeah. So generally, this CRISIL, these credit rating agencies will be rating the debt instruments of the companies. So depending upon the credit rating, because in case of individual also, SEBIL will be giving credit rating. They will be giving a SEBIL score. Most of the banks prefer to lend the loan if the SEBIL score is more than 750. So this SEBIL score is nothing but which mainly deals with the repayment capacity of an individual. In the same way, for the companies also who are engaged in issuing the debt instruments, this CRISIL will be giving certain credit ratings. So the depending upon the credit ratings, the market value of their financial liability will depends. Suppose if the company's credit risk increased, if the company credit risk increase, definitely it is going to affect the market value of their financial liabilities. So here what I'm trying to say, if there is any significant change in the carrying amount and the market value of a financial liability because of credit risk of the company, that particular amount should be shown in the other comprehensive income. But before 2018, the total revaluation gain or loss, generally they use, we need to show it in the statement of profit or loss account. But after an amendment in 2018, if there is any significant change between the carrying amount and the fair value of a financial liability due to the credit risk of a company, In that case, that particular credit risk amount should be shown in the statement of other comprehensive income. And if the difference is because of any other reasons, then that amount will be showing in the statement of profit or loss account. I hope you understood these two statements. Next, compound financial instruments. Now it means these are the financial instruments which have a characteristics of both a liability and a equity. Both a liability and a equity. Now these kind of financial instruments are known as compound financial instruments. So here an example would be debt that can be redeemed either in cash or a fixed number of equity shares. Now as per IAS 33, IAS 32, in case of compound instruments, we need to split the financial liability and the equity instruments. Now the equity amount will be shown as an equity and the financial liability will be shown as an amount. Now let me give an example. So I am expecting everyone to please focus on this. Yeah. Uh, X company issued 1 lakh worth of debentures. X company issued 1 lakh worth of debentures, and the debentures are to be redeemed after 2 years. Debentures will be redeemed after 2 years. Redeemed is nothing but repaid. So the debenture holders will be repaid after 2 years. And at the time of redemption, the company agrees to pay 20% in cash and remaining 80% as equity shares to the debenture holders. Once again, I repeat, X company issued a debentures of 1 lakh, and these debentures are redeemed after 2 years. It will be redeemed after 2 years. At the time of redemption, the company agrees to pay 20% in cash and remaining 80% through equity shares. These kind of financial instruments are known as compound financial instruments because the first important thing, they are having a liability, because after 2 years they need to pay 20% in cash, so that is a liability, and remaining 80% they will be issuing the shares, that is nothing but the equity. So any financial instrument which have both the characteristic of liability and equity, those should be considered as compound financial instruments. So as per 32, we need to calculate separately the financial liability part, and we should calculate the equity part. Liability part will be showing in the as a liability, and equity will be showing as a liability. What is this equity? Now, how to calculate the what is this the liability part and how to calculate the equity component? Now the best example for this one. So here same example will consider. Z company issued 1,000 debentures. Here 1,000 debentures, we'll write it as 1,000 convertible debentures. Z company issued 1,000 convertible debentures at the rate of 10 each at a coupon rate of 8% per annum for 3 years, and the effective rate of interest is 7%. Now in this case, the total amount is 1 lakh, and 1 second. Here we'll take coupon rate of interest as 10%. Yes. Now, Z company issued 1,000 convertible debentures at the rate of 100 each at a coupon rate of 5% per annum for 3 years. Effective rate of interest is 12%. Now, here they clearly mention it is convertible debentures. Now, convertible debentures means, as I said, after the time of after the redemption period, company will be issuing the equity shares. Now, in these convertible debentures, as per IAS 32, we need to calculate the financial liability part and we need to calculate the equity part. So here just see this one. How to calculate the liability component? Calculated as a present value of the repayments discounted using the rate of non-convertible debt. Then equity component calculated as a proceeds received less the liability component. So in this case, I am not explaining the because already you might be knowing this calculation part. If you see the present value of the liability is 90,521. The company issued it for 3 years, but when they issued the total proceeds is 1 lakh. But when they calculated the present value, its present value will be only 90,521. So this 90,521 should be calculated as a finance liability. We need to show it as a finance liability. And the difference amount means 1 lakh minus the uh, finance liability part, that is 90,521. The difference amount, that is 9,479, should be considered as equity. So this particular process should be followed when we are dealing with the compound financial statements. So this liability component, that is 90,521, it should be considered as a financial liability, and the difference amount. So what net proceeds, the net here the proceeds is 1 lakh. From this particular proceeds, if you deduct the liability part, the difference which you will be getting is 9,479. It should be considered as a equity. So this particular calculation will be doing according to the IAS 32. I hope you understood this. Yeah. Once again, I'm repeating. When the company is dealing with convertible debentures, the convertible debentures means debentures amount should be redeemed after a specific period of time. But if it is a convertible debentures, the company will have an option to repay the debenture amount by issuing the equity shares. It means they can pay certain amount in cash and they can issue their equity shares also. So those kind of debentures are known as convertible debentures. Now, these kind of convertible debentures is the best example for your compound financial instrument. So, compound financial instrument means any instruments which have a characteristic of both equity and the financial liability. Now, when we are dealing with the compound financial instrument, as per IAS 32, first we should calculate the present value of that instrument. Now, the process of calculating the present value is this: the number of years is 3 here, because the debenture amount will be redeemed after 3 years. So, the number of years will be 3, and cash outflow. Every year we will be paying 5% as interest on that. So, on 1 lakh, if you pay 5,000, it will be 5,000 rupees, and at the end of third year both principal and the interest amount will be repaid. So that's why 1 lakh plus 5,000, that is 1 lakh 5,000. And here we need to calculate the discount factor by using the effective rate of interest. These are nothing but discount factors. Now if you calculate this, you will be getting a present value of 90,521. Actually you issued the debentures for 1 lakh, but its present value is only 90,521. So this 90,521 should be considered as a financial liability, and the difference amount. So the difference 1 lakh minus 90,521, whatever difference which you get, the difference amount should be shown as a equity. Yeah. If the issued capital and the subscribed capital is equal, now do remember this will not be included in IPO. This is not an initial public offering. So in this case, uh, it is not necessary that suppose if the issued and the subscribed capital is equal, it not. So in this case, the company can issue the convertible debentures irrespective of their shares, nothing but irrespective of this issued capital and the subscribed capital, because it should be considered as issue of shares to the existing shareholder, nothing but it will not be considered as a IPO, it will be considered as a NPO, that is new public offering. I think you might be knowing NPO means new public offering. It means, suppose let us assume that the total issued capital of a company is 1 lakh shares, and if the total 1 lakh shares is also subscribed, now it doesn't mean that the company won't issue this convertible debentures. Irrespective of it, the company can do this. But most importantly, you need to remember that the total shares should not be more than the authorized capital. It should not be more than the authorized capital, but here we should not consider about the subscribed and issued. And in some situations, if it become mandatory, suppose if the company is in severe liquidity crisis, in that case they can do their they can amend their capital clause, and even they can what is this, increase their authorized capital also. So by amending their capital clause also, they can issue the convertible debentures. I hope this is clear, Vignesh. I think Harsh, I think you might be facing some technical issue. Am I audible to you, Harsh? Because I can see that you frequently losing your connection. Am I audible now? Now the next one is financial assets. So when we are dealing with the financial assets, initially financial assets are yeah, Harsh, am I audible now? So financial assets initially it should be recognized at fair value. Now here also you need same concept we will be applying like financial liabilities. Now if you are dealing with the trading companies, if you are dealing with the trading companies, transaction cost on the financial asset should be shown in the statement of profit or loss account. And for a non-trading company, the transaction cost should be added to its carrying amount. Now, if you remember, in case of financial liability, the transaction cost will be deducted from the carrying amount. Now, in case of financial asset, the transaction cost should be added to the carrying amount if it is a non-trading company. But for a trading company, transaction cost should be shown as an expense in the statement of profit or loss account. So it is simply how we can understand. Initially, when you are recognizing the financial assets, it should be done through fair value. It should be done through fair value. Yes. Yeah. I think some issue with his connection, so that's why he's unable to hear me. So when we are dealing with the financial assets initially, as I said, it should be through fair value. But here you need to uh, differentiate it. If the company is a trading, then consider the transaction cost and expense. And if the company is a non-trading, then add this particular transaction cost to the carrying amount. So this is the thing which you need to remember when we are initially recognizing the financial assets. Yes. Now, investment in equity. Suppose if the company is investing in the equities, such as investment in ordinary shares of another entity, generally it is valued at fair value through profit or loss account. Now, it is possible to measure an equity instrument at fair value through profit or loss account, fair value to other comprehensive income, but certain conditions should be satisfied. Once again, I repeat, if a company purchases the equity shares of another company, in that case, it should be valued at fair value through profit or loss account. Normally, it should be valued at fair value through profit or loss account. But we can go with fair value through other comprehensive income, but certain conditions should be satisfied. The first condition is the equity instrument is not held for trading. That is the first condition. Second condition is an irrevocable choice for its designation is made upon the initial recognition of the asset. The most important statement. An irrevocable choice for this designation is made upon the initial recognition of the asset. It means once it is considered or nothing but if the company is in non-trading business, and second important thing is if there is no option to the holder to redeem it after a specific period of time, in that case then we can show it in the fair value through other comprehensive income. Now here the slight difference is if it is a trading means it should be done through fair value through profit or loss account. It means if there is any significant difference between the fair value of the asset and the carrying amount of the asset, that difference will be shown in the statement of profit or loss account. But if you want to show the difference in the other comprehensive income, the first condition is that the equity shares should not be traded. It should not be held for trading. Nothing but the company should not purchase those shares for the purpose of speculation. And the second one is an irrevocable choice for this designation is made upon the initial recognition. It means if you decided to show the difference in other comprehensive income, no matter it may be gain or loss, because most of the companies what they will be doing is if there is any gain on revaluation, then they want to show it in the statement of profit or loss account, but they don't want to show the loss in the statement of profit or loss account. If you want to show it in other comprehensive income, then that particular decision should not be changed. irrespective of the position of that particular shares. So then only we can show it in the statement of other comprehensive income. So see, simply here you can understand this. Fair value through other comprehensive income can be used, not held for trade, and irrevocably designated. In other case, generally we can show it in the statement of profit or loss account. But practically, we cannot go with this one. Generally, when we are investing in the equity shares, we will be following this method only. Fair value through profit or loss account. So any questions you want to ask on investments in equity? Yeah. So this investment debt is a separate concept. I prefer to discuss this in tomorrow's session only. I want to end with this equity only because Harsh, I think, is unable to hear me now. Who is taking the responsibility of this attendance? I hope Harsh took the attendance. I think so. Yeah, yeah, yeah. Okay, very good. Yes.
Sir, can you hear me?
Yeah, Harsh. Is it Harsh?
Yes. Hello.
Yeah. Hello.
Hello, yes, sir. Am I audible, sir?
Yeah, yeah. You're audible. You're audible.
Add the attendance.
Yeah, yeah. Thank you. Thank you. So, investment in debt, I will discuss in tomorrow's session. Okay. Because today I'm very tired. So, that's why I want to discuss this concept tomorrow session. Okay. Right. Right. Bye.
Thank you, sir.
Yeah.